Welcome back to the Crypto Intellect, your home for the biggest developments in crypto, blockchain, and institutional finance. Today, we're diving into a topic that has XRP holders talking across the entire market, XRP news. Today, $4.7 quadrillion XRP. Boom incoming? Now, before we get started, let me be clear, this is not financial advice. This content is for educational and informational purposes only, and you should always do your own research before making investment decisions. With that said, what we are seeing unfold around Ripple, XRP, institutional adoption, tokenization, and financial infrastructure is becoming harder and harder to ignore. The headlines may sound dramatic, but behind those headlines are real developments involving major financial institutions, clearing systems, tokenized assets, and cross-border settlement infrastructure. If you've been following XRP for years, many of these developments may feel familiar. The difference now is that the pieces appear to be connecting in ways that were once considered purely theoretical. So before we go any further, I want to ask you a simple question. Do you think XRP is finally entering the phase where institutions begin using the infrastructure at scale? Drop a yes or no in the comments right now, because this discussion is going to challenge a lot of assumptions about where XRP may be heading next. One of the biggest developments drawing attention recently is the growing conversation around Ripple Prime and its role within institutional financial infrastructure. Most retail investors focus on price charts, exchange listings, or short-term market movements. Institutions think differently. They focus on infrastructure, they focus on efficiency, they focus on settlement, they focus on reducing risk and increasing speed while lowering costs. What makes this conversation important is that Ripple Prime has reportedly been integrated into processes connected to major financial settlement systems. That may not sound exciting at first glance, but infrastructure is where real financial transformation happens. The systems moving trillions of dollars every year are not rebuilt overnight. They evolve gradually. What many people miss is that adoption often happens quietly. The biggest changes in finance are rarely announced with fireworks. They happen through integrations, partnerships, testing environments, regulatory approvals, and operational deployment. By the time the public notices, the infrastructure is already in place. That is why so many long-term XRP supporters pay close attention to institutional developments rather than daily price fluctuations. They understand that if XRP becomes part of critical financial infrastructure, the implications could be much larger than anything reflected in current market valuations. To understand why this matters, we need to look at how institutional trade settlement actually works. Most people assume that when an asset is bought or sold, the transaction instantly completes. In reality, institutional settlement involves multiple steps, multiple parties, verification processes, risk checks, clearing procedures, and final settlement mechanisms. Every stage must operate correctly because the financial system depends on trust and accuracy. When trades move through these systems, data must be verified, capital must be confirmed, compliance requirements must be met, and risk exposure must be managed. This is where Ripple Prime's reported role becomes significant. If Ripple-related infrastructure participates in any portion of these workflows, it places Ripple technology inside environments where major institutions operate every single day. That is very different from speculative crypto use cases. It represents practical utility. Financial institutions care about reliability, compliance, and efficiency. If a technology can improve those areas while reducing operational costs, it naturally becomes attractive. The key point here is not whether every trade uses XRP today. The key point is that the infrastructure itself appears to be moving closer to environments where XRP-related technology can play an increasingly important role over time. Another critical aspect of this discussion revolves around clearing and affirmation. This is one of the least understood but most important areas of modern finance. Before a trade can move forward, institutions need confirmation that capital is available, risk requirements are satisfied, and regulatory obligations have been met. Without these checks, the entire settlement process would be vulnerable to failure. When investors hear terms like designated clearing agent, they often overlook the significance. These roles are not ceremonial. They exist because financial markets require trusted intermediaries and operational controls. If Ripple-related systems are involved in any capacity within these workflows, it demonstrates that the technology is operating in environments requiring high levels of trust and oversight. This is exactly the type of progress long-term XRP supporters have anticipated for years. The vision was never simply about speculative trading. The vision was about becoming part of the underlying infrastructure powering global value transfer, Whether that vision ultimately reaches its full potential remains to be seen, but the trajectory is becoming increasingly interesting as more institutional names appear connected to Ripple's ecosystem. What makes the situation even more fascinating is the connection between traditional financial infrastructure and tokenization. Tokenization has become one of the hottest topics in finance because it allows real-world assets to exist on blockchain-based systems. Stocks, bonds, treasury instruments, real estate interests, and other financial products can potentially be represented digitally. The benefits are significant. Settlement can become faster, transparency can improve, costs can decline, accessibility can expand. Some of the world's largest financial institutions are actively exploring this transformation. When major organizations begin investing resources into tokenization, it signals that they believe the technology offers meaningful advantages. XRP supporters often point out that the XRP ledger was designed with asset transfer and settlement efficiency in mind. As tokenization expands, questions naturally emerge regarding which blockchain infrastructures will support these assets. Nobody knows exactly how the market will evolve, but it is clear that tokenization is no longer a fringe concept. It is becoming a serious conversation among some of the most influential financial organizations in the world. David Schwartz, Ripple's chief technology officer, has often described a future where multiple networks coexist rather than a single dominant system controlling everything. This perspective is important because it reflects how the internet itself evolved. The internet did not succeed because one company controlled every website. It succeeded because different networks could communicate with one another. The interledger protocol was designed around a similar concept. Instead of forcing every institution onto one ledger, the goal was to create interoperability between different systems. This distinction matters because financial markets are incredibly diverse. Different jurisdictions have different regulations, different institutions have different requirements, different asset classes have different settlement needs. A network of networks approach may prove more realistic than expecting the entire global financial system to migrate onto a single blockchain. If interoperability becomes the key challenge, technologies capable of connecting multiple systems could become increasingly valuable. This is one reason XRP supporters continue watching developments around interoperability, liquidity, and cross-border settlement with such intense interest. The conversation becomes even more compelling when we examine netting systems. Netting is one of those financial concepts that sounds boring until you realize how much money it saves. Rather than processing every transaction individually, netting systems calculate the difference between obligations and settle only the net amount. This dramatically reduces the movement of capital and decreases operational complexity. Reports involving Ripple-related treasury solutions and large corporate clients demonstrate how these concepts are being applied in practical environments. For multinational corporations operating across numerous countries and currencies, payment management can become extremely complicated. Every transfer involves costs, timing considerations, foreign exchange exposure, and administrative work. Netting solutions simplify those challenges by consolidating obligations into more efficient settlement structures. This may seem like a niche application, but when multiplied across global commerce, the potential savings become enormous. Institutions are constantly searching for ways to improve efficiency, and solutions capable of reducing friction naturally attract attention. That is why these developments continue generating excitement within the XRP community. One company frequently mentioned in these discussions is Franklin Electric, a business generating billions of dollars in annual revenue. What makes this notable is not simply the company's size. It is the practical demonstration of how modern treasury solutions can improve operational efficiency. Large corporations manage enormous flows of capital between subsidiaries, suppliers, customers, and international operations. Every improvement in settlement efficiency creates measurable financial benefits. When financial giants like JPMorgan collaborate on solutions connected to Ripple-related technology, investors pay attention. These are not organizations experimenting casually. They evaluate technology through the lens of cost savings, risk reduction, scalability, and operational performance. The significance lies in the fact that real companies with real financial needs are using modern payment and treasury tools to solve real-world problems. That is the type of adoption that creates long-term value because it is driven by utility rather than speculation. Whether XRP ultimately captures a central role in these processes remains a topic of debate, but the infrastructure developments themselves are undeniably meaningful. At the same time, another battle is unfolding within the tokenization industry. On one side, we have institutions upgrading existing infrastructure from within. On the other side, we have blockchain-native organizations building entirely new models. This distinction is crucial. Traditional financial institutions often prefer evolutionary change because it minimizes disruption and maintains regulatory compatibility. Blockchain-native organizations tend to favor revolutionary change because they believe existing systems contain structural limitations. Both approaches have strengths and weaknesses. The institutional model benefits from trust, scale, and regulatory relationships. The decentralized model benefits from innovation, accessibility, and flexibility. What makes Ripple unique in this conversation is its apparent ability to engage with both worlds. Rather than choosing one side exclusively, Ripple has built relationships across traditional finance and blockchain-based ecosystems. If those two worlds continue converging, companies positioned at the intersection could find themselves in a highly advantageous position. This is where Securities enters the discussion. Securities has emerged as one of the most influential players in the tokenized asset sector. The company has become deeply involved in bringing real-world assets onto blockchain infrastructure. When organizations operating at this level establish connections with Ripple-related technologies, it naturally attracts attention from investors. The tokenization market is still relatively young, but many analysts believe it could become one of the largest opportunities in financial technology. If trillions of dollars in assets eventually move on to blockchain-based systems, the infrastructure supporting those assets will become increasingly important. XRP supporters often argue that the XRP ledger's speed, efficiency, and liquidity capabilities make it a strong candidate for participating in that future. Skeptics counter that competition remains intense and that many platforms are pursuing similar opportunities. Regardless of which perspective proves correct, there is no denying that tokenization has become one of the most important trends shaping the future of finance. Another fascinating piece of this puzzle involves RLUSD and its growing role within Ripple's ecosystem. Stablecoins are becoming increasingly important because they combine blockchain efficiency with price stability. Institutions generally prefer stability when moving large amounts of capital, which is one reason stablecoins have attracted so much attention. By integrating stablecoin functionality into broader financial infrastructure, Ripple expands its ability to serve institutional needs. Some observers view RLUSD as a bridge connecting traditional finance, tokenized assets, and blockchain-based settlement. Others see it as a strategic complement to XRP itself. Regardless of how one interprets its role, the broader trend is clear. Financial institutions are exploring digital representations of value at an accelerating pace. Stablecoins, tokenized assets, and blockchain-based settlement mechanisms are increasingly becoming part of mainstream financial discussions. That trend alone represents a major shift compared to where the industry stood just a few years ago. Now let's talk about the number that has captured everyone's attention, the massive valuation figures and projections circulating throughout the XRP community. Headlines mentioning trillions, quadrillions, and enormous liquidity pools generate excitement because they suggest unprecedented potential. However, it is important to separate speculation from infrastructure realities. The reason these numbers appear in discussions is that global finance itself operates at extraordinary scale. Cross-border payments, treasury management, securities settlement, derivatives markets, and tokenized assets collectively represent enormous amounts of value. If even a small percentage of those flows eventually utilize XRP-related infrastructure, the implications could be significant. The challenge is that nobody can accurately predict future adoption levels. Markets rarely develop exactly as expected. What investors can do is evaluate the trajectory of institutional engagement and determine whether the infrastructure appears to be moving in the direction supporters have long anticipated. That is ultimately why these developments matter more than any single headline. Brad Garlinghouse has repeatedly discussed the long-term movement of financial activity onto blockchain-based systems. His projections focus not on overnight transformation but gradual migration. This perspective aligns with how financial infrastructure historically evolves. Major systems do not change overnight because stability matters. Institutions move carefully. Regulators move carefully. Infrastructure upgrades require testing, compliance reviews, operational validation, and extensive coordination. While some investors become frustrated by the pace of adoption, others view gradual integration as evidence of seriousness. The financial world tends to reward reliability over speed. If blockchain technology continues proving its value, adoption may expand steadily over time. That possibility is one reason XRP continues maintaining such a dedicated community despite years of volatility, regulatory challenges, and market skepticism. One statistic that continues generating attention involves the growth of real-world assets connected to the XRP ledger ecosystem. Growth figures showing dramatic increases over relatively short periods suggest that institutions are becoming more comfortable placing assets onto blockchain-based infrastructure. While growth percentages alone do not guarantee future success, they provide evidence that adoption is occurring. For years, critics argued that institutions would never embrace blockchain technology for meaningful financial operations. Today, that argument appears increasingly difficult to defend. The question is no longer whether institutions are exploring blockchain. They clearly are. The question is which networks, platforms, and technologies will capture the largest share of that adoption. That remains one of the most important unanswered questions in the entire digital asset industry. When you step back and look at the broader picture, a pattern begins to emerge. Ripple-related infrastructure appears connected to institutional settlement discussions. Major banks are exploring payment efficiencies. Tokenization is accelerating. Stablecoins are expanding. Real-world assets are moving on-chain. Regulatory clarity is gradually improving in several regions. None of these developments alone guarantees a specific outcome for XRP. However, together they paint a picture of increasing institutional engagement with blockchain-based financial infrastructure. That is why so many investors continue monitoring every Ripple announcement, partnership, integration, and ecosystem update. They believe these developments represent pieces of a much larger transformation that is still unfolding. As we wrap up today's discussion, the biggest takeaway is that infrastructure matters. Prices can move up and down every day, but infrastructure determines long-term utility. Ripple Prime, institutional clearing conversations, JPMorgan collaborations, tokenized asset growth, securitized partnerships, RLUSD adoption, and cross-border settlement innovation all point toward one central theme. The financial system is evolving. Whether XRP becomes one of the primary beneficiaries of that evolution remains to be seen. But the conversation has clearly moved far beyond speculation alone. Real institutions are building. Real infrastructure is being deployed. Real assets are being tokenized. And real questions are being asked about how value will move in the next generation of finance. So now I want to hear from you. Do you believe the institutional model ultimately dominates, or do you think the decentralized model wins in the long run? Let me know in the comments below. If you enjoyed this breakdown, make sure you like the video, subscribe to the Crypto Intellect, and share this with someone who needs to understand what is happening behind the headlines. Until next time, stay informed, stay prepared, and I'll see you in the next one.